everyone, and welcome to the InvestSMART Bootcamp, Week 2. I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and this week we're covering off the different investment vehicles module. So that's module 3, and it's covered off in Week 2. So let's jump to it. The disclaimer there, as usual, basically we can't provide any specific or personal financial advice. It's general only in nature. So about this webinar and the previous ones that we've done so far, they're basically designed to cover off any questions that you've got as you go through the learning material. We don't give financial advice, as you've already read. So if I get a question about any kind of financial advice that's personal, I'll try and rephrase it to make it a bit more general in nature. We need to stick to the course content, so that means that questions need to be related to this particular module. If not, I'll just point you into the direction of the module and the webinar that's been saved that can help. We also like to make sure that you're using the available resources. So that's the Intelligent Investor and also Eureka Report, along with the InvestSMART website. And just as always, this is an introductory course. It's not an advanced course, not a university course. So it won't cover off detailed theories or any kind of long equations, which is probably a relief to some people. So week 1, just to recap, we looked at the importance of investment planning, and that was having a goal, knowing your time frame, and also being comfortable with your level of risk or understanding that. I always use the example of myself saving up for a home deposit, so a home loan deposit to purchase a house. That's my goal. I've given myself 3 years to do this. I think that's achievable. So straight away, I've set my own time frame. The risk, for me, I'm fairly comfortable with risk, but I don't want to go backwards, which just means that I want to end up with more than I started. I don't want to lose any money because this is quite important to me. So we also learn about diversification. So that is basically saying you're spreading your risk. You're not going to put all your eggs in one basket. You're going to invest into different assets. And then asset allocation talks about what percentage actually goes into certain areas. So for example, we might look at, in my case, I probably want a fairly conservative type approach. So I think that's not going to be too risky. So I might allocate a higher percentage to defensive type assets like fixed interest or fixed income, such as bonds or savings accounts, those kind of assets. So this module will look at the different investment vehicles that you can invest in. So basically the types of things that you can invest in. And first of all, we look at shares and exchange traded funds. These are fairly similar to each other. They trade on an exchange, have a buy and sell price. They pay dividends or distributions. The next step is the managed funds and managed portfolios. Fairly similar to each other, but there are some strong differences as well. And lastly, the cash and bonds, so more defensive type assets, usually lower return, but lower risk. So with shares, as it's covered off in the bootcamp content, you are looking for an increase in value. So that's if you buy it at a lower price and then you sell it at a higher price later. That's basically one way to profit, and we call that capital appreciation or capital growth. But they also pay dividends. So they pay out a percentage of the earnings that the company makes, and they pay it back to the shareholders. Not all of the shares, though, pay a dividend. Some decide to keep it and retain the earnings and usually use it to grow the company or maybe spend it on research, for example. So with shares, you'll need a broker to trade. Basically, you can set up an account with a number of different brokers like CompSec or NabTrade, to name a few. They will make their money from you from either charging you brokerage, or some of them charge account keeping fees to keep it open. But you'll basically pay brokerage per trade. So a trade is when you buy the shares and then when you decide to sell them as well. So definitely keep an eye on that. There's different strategies with shares, but they can include value investing, growth investing. So basically you could be on the lookout for shares that might be undervalued based on a number of different metrics. And that could be a strategy in which you can get the share at a lower price, and then fingers crossed goes up in a certain time frame. So we have a number of different tools, particularly Intelligent Investor. Let's have a quick look. I'll just jump to them. So I can go to Intelligent Investor at the top, and they've got recommendations. So they've got the latest. They've also got all the buy, hold and sell, and they talk about value investing here. The value investing section will also talk to you about what the buy, hold, sell actually means. I'll click on that quickly. And you can see here they're explaining value investing for us, but here they also talk about the recommendation guides and how to understand them. Of course, there is still the research that Intelligent Investor offers, and that's really handy if you want to find more in-depth information into a particular company, and the analysts will write about it. So Ordinate, for example, 3 hours ago there was an article written by James Carlisle, and he'll give you his updated recommendation here on the right hand side. So this is really handy. They go through a lot of the different ratios as well, and it'll save you a lot of time if you wanted to be more of an active investor. There's tools up here as well, the stock screen, so you can screen a number of different stocks, look at director interest, so directors who are buying and selling in their own company, along with listing all the dividends and different share prices. ETFs are the second part of the exchange traded securities. So an ETF is an exchange traded fund. It's basically a fund that is trading on something like the ASX. There's different types that you can get, active and passive. So an actively managed ETF, a good example would be the Intelligent Investor Growth Fund that we listed just recently. That's got a team of analysts behind it who are actively out there picking and choosing different investments to go into it, and then they list that fund onto the exchange where it can be traded. So exchange traded fund. You can get ETFs that track stocks, some that track government bonds or even corporate bonds. There's even ones that track different sectors and industries as well. Of course, there's international commodity, and there's even ones called factor ETFs, but they're a bit more riskier, but they are an active ETF. The best way to describe an ETF, I think, is if you look at something like the index, the Australia 200, and what it is, it wraps up the top 200 shares. So you could go out and buy the top 200 Aussie shares by market capitalization, and that would include BHP, Combank, Flight Centre, Ordinate, etc. You'd pay brokerage each time if you were to buy them separately as a share, but if you bought an ETF that wraps them up, you're just buying that one ETF. So that means that the brokerage is only for one transaction, and also dividends are still paid to you, but in the form of distributions, they call them. You don't also have to worry about constantly readjusting different sizes, because it can fluctuate based on the ASX 200, as the ETF manager will do this for you. So with the ETFs, you'll need a broker as well to trade, very similar to shares. And again, you pay brokerage to buy them and then to sell them as well. And as we saw, there's many different types of ETFs. So Intelligent Investor, let's jump back to their website, because they actually offer ETFs for you to own. So I'll go to portfolios, and there's the Equity Income Fund, which uses the ticker code INIF on the ASX. There's the Ethical Share Fund, which uses the ticker code INES, and then the newly listed Equity Growth, which is IIGF. And you can buy and sell these like a share, but we manage the actual investment decisions that go inside them themselves. And I'll give you a bit of a rundown here in terms of what kind of allocations they're looking at. Eureka Report also has a handy filter tool that lets you filter ETFs or exchange traded funds, so you can try and find some that might suit your requirements. You've also got the Ask Alan section here, where you can submit and view questions. See the older ones that have been asked. He'll get some questions about ETFs occasionally, and we'll answer them here. So that's a very good resource. I highly recommend that you take advantage of this. So with managed funds, basically it's investors pooling their cash together and then buying into a fund where it's managed by another person or another company. Each investor then has a unit or a part of that fund, and that unit is priced accordingly. You can get ones that are listed on the exchange, and they're called LICs, or listed investment companies. Berkshire Hathaway, that trades in the US, is a great example of this. it in itself then buys up a number of different other companies. But you can also buy unlisted, such as unlisted property funds that will buy or manage commercial properties. Some of those come with a few more risks in that they can charge some fees that are uncapped, so potentially open. And then they also can charge a performance fee as well. So if they reach their benchmark or their target, anything over, you'll pay an additional fee as well. So just keep an eye on that. Again, there's different filter tools on Eureka Report. And you've got listed investment companies here, but you've also got exchange traded funds, managed funds as well. The other thing is that Alan Kohler, he does a lot of extensive interviews with the owners of managed funds, also CEOs and other people who are involved in things like that. So that's a really handy behind the scenes resource. It gets you a lot of extra information, and this is the CEO interview part here. So managed portfolios, well, the best way to explain these is you've got your own portfolio that you might have some shares, but instead of you picking and choosing and understanding like the investment strategy and doing all the reporting, someone else, a manager, does that for you. You can different types, active and passive. So someone who's out there trying to outperform the market, or they might take a passive approach where they're happy just to get the returns that the market is offering, not trying to outperform, just copy the same kind of returns. A managed portfolio, just like your own share portfolio, means that you own the underlying assets. So if you wanted to transfer your shares out to another broker, you can do that as well. Again, there's always the risk that some of the managed portfolio companies or managers will charge uncapped fees, and some of them also charge percentages or performance-based fees. So keep an eye on that as well. We've got a few products at InvestSMART, and I talk about InvestSMART products because I'm familiar with them. There are others out there, so I do ask that you do your own research as well. But I'll mention these because I'm across them myself. So for example, you've got the InvestSMART Passive Diversified Funds. And I'll jump to our website just here, investsmart.com.au. And you can see Invest with Us. If I click on this, it'll take me to the list of the passive funds that we've got, or portfolios. So if I looked at, say, conservative, balanced, growth, they all show their time frame. Performance, which is backwards looking, so how well it's done so far since 29 December 2014, and that's per year on average. And then estimated income, so that's how much it estimates to earn per year, and that's forward looking, so that's what we can expect. If I was to hop into the growth, I'll jump in there, and you can see that with the growth portfolio, it's passively managed, and it has different allocations, so some to international shares, some to Aussie shares, and then fixed interest, property, and some cash. If I go down a bit further, you can see that it will show you the allocation, and we actually go out and purchase ETFs to get exposure to those particular areas. So like in the example I spoke about before with ETFs, for us to get exposure to the Australia 200, the top 200 shares by market capitalization, we won't go out and buy individual shares 200 times. We'll actually buy an ETF, which just happens to be this one that's right here, the iShares MSCI Australia 200 ETF, and that trades on the exchange on the ASX with the ticker code IOZ. And that will give us exposure to the movements in the Australia 200. So fingers crossed it would continually go up, or if it had one bad year, then so be the case, but the others would hopefully be positive years. We would then get that same return, less any fees. Speaking about fees, the InvestSMART portfolios that are diversified, they have capped fees. So starting off at $99 per year, but as soon as you have more than $82,000 across any of our portfolios in the InvestSMART range, they cap out. So you'll only ever pay $451 per year for the management fee. Intelligent Investor, they used to have managed portfolios, and these were active, which meant there's a team behind picking and choosing what to go in. They, as I mentioned, have since been listed on the ASX, so you can only buy them now through a broker, which helps to reduce some costs as well. So with cash and bonds, they are often called risk-free, which means that there's no risk that your capital won't be returned to you. So you'll get your capital back, the amount you started with at the end. Some academics say that that is not entirely true. There is always a risk, and you can look at interest rate risk as well, basically meaning that in the time that you've owned it, the interest rate could go against you, and you could actually end up with less in terms of not what you started with, but you'll lose out on opportunity as well, so opportunity cost. You tend to see these with term deposits, savings accounts, and government bonds. In fact, Liz Moran, she writes extensively in Eureka Report. Go to the experts, Elizabeth Moran, and she's written a lot of content on bonds, given her background. So this part itself is such a very handy area if you're interested in investing in bonds. And she does talk about not only government bonds, but she'll also talk about corporate bonds, so companies issuing bonds into the market as well. She also talks about looking for the best deposit rates here too. InvestSMART actually has its own tools at the top, and you can search for the best return or term deposits. And term deposits obviously have a number of different features, but as you can see, they're a little bit low at the moment, but this tool is quite handy and it'll help you match to something that might be suitable. We had a question at the before the webinar that was submitted by Tony, and he was basically saying, how do you go about finding a good fund manager? Like, what's one way to identify a good fund manager? And there's some tools on the InvestSMART website, Compare Your Fund tool, where if you've got a current fund that you're invested in, managed or super, you can compare this against others. You can type in the fund name, the manager, or the special code that is on the documentation you've received. Essentially though, in terms of identifying a good fund manager, you want to go with someone who is transparent, tells you all the fees up front. We have a really strong approach in terms of making sure that investing is cost affordable and the money stays in your pocket. So that's why with the InvestSMART range, we've introduced the capped fees. There's a strong argument that if we can do it, anyone else can do it as well. So you've got to ask yourself that question, why doesn't the industry do something like that? Particularly when, if you look at, let's just choose the balanced. If you were to compare the returns, you can see that the InvestSMART balanced is the salmon type color there at the top, and the bluish is the average of the 566 peer funds. So other funds that have similar approach, same kind of target, and we're comparing ourselves to their returns. And what you'll find is that this line is getting bigger and bigger since we've started our fund, and that's a lot of the time due to the fact that we cap our fees. So it means that our fees stay low, the money stays in your pocket, you get the benefit of compounding returns, which means it grows quicker. But essentially, identifying a good fund manager, it's good to know what their approach is, whether they have the active or passive, knowing their fees, whether they cap their fees or whether or not they charge open-ended percentages as a fee, whether they have a performance-based fee as well, and just make sure that they're trying not to compare themselves against something that's really achievable. So some funds will choose something like the Reserve Bank overnight rate plus 1%, which at the moment, given it's so low, it's very easy to beat. So they will charge you that outperformance fee on top of a regular fee. You want to make sure that it's obviously reputable. So maybe read some reviews, look at different kind of rating systems. In the Compare Your Fund, we do have a rating provided there as well in terms of stars. Obviously, you want to look at the returns they're providing. The past performance is not always a good recommendation or indication of future performance, but it does help in a sense that you do want to know how it has tracked so far. So that's all the questions that we've gotten so far. What I might do is just leave this webinar now, and if you have any questions for the next week's webinar, you can either enter them when you're registering for the next week, or you can come along and ask during the webinar, or even email us at bootcamp@investsmart.com.au.